With smiles on their faces, they go on television and say, everything's fine. The market is fine. The banks are fine. In fact, it's your fault for panicking that causes the banks to fail in the first place. It's not the failed economic policies of the gigantic Federal Reserve and international Ponzi scheme that they've been running. No, it's in fact your fault for being worried about whether or not you will have money in the bank. Right now, we're learning that the Fed will inject $2 trillion of liquidity. Let me see if I can get the story. JP Morgan says Fed's loans, mind you, will provide $2 trillion of liquidity. This is a Band-Aid on a bullet wound. The Treasury bonds are down. Everybody's freaking out. And I don't know anything about what this means other than I'm looking at the financial sector and financial commentators. And you've got the corporate press being like, what are you worried about? Things are better than ever. And then I can look at these independent personalities saying, yo, this is the craziest we've seen in a really long time. But you know what? I'm not a finance guy. But you know what I am? A tech guy. Which is why, in the context of a massive injection of trillions of dollars, a failing banking system, the Dow coming down, I have this story for you to contextualize it. A rogue version of ChatGPT predicted that the stock market would crash this week. Here's what it got right and got wrong. In fact, it got it right for the most part. I mean, it's not like we're in the Great Depression just yet, but it actually got this right, which is really, really creepy. I want to show you some contextual information first. We have this from Nick Gurley. I saw this on Twitter. He said investors are freaking out right now. U.S. Treasury yields plummeted an insane 80 BPS the last 2 days. The biggest drop in yield since 1987's flash crash. Bigger than what happened after 9/11 and Lehman Brothers. Is a market collapse coming? Take a look at this. Treasury market warning. The source is Fred. You can see here a 2-year yield change going down. The 1987 flash crash was about 1.15 point decline. September 11th was 0.65 maybe. Lehman Brothers was at 0.40. And right now we are past both of those. Now, I'm going to be honest with you. I have no idea what that means. I understand general context of the Treasury market is declining very rapidly, and it does show us similarities to Lehman Brothers and 9/11. But what does that mean? Not entirely sure, to be completely honest. Just that people who are more in the know than I are very worried about what is actually going on. And then you have this from newsbtc.com. The U.S. Fed is sitting on $1.2 trillion losses on its bond portfolio. Wall Street Silver tweeted, if you thought Silicon Valley Bank was bad, the Fed is sitting on unrealized losses of $1.2 trillion on their $8.3 trillion bond portfolio. And the Fed is losing money every day by paying money to commercial banks via reverse repos. And this is the biggest issue I see. Look, I can only do one thing. Admit that I'm not a financial guy. I'm seeing all of these stories, which are worrying, but I can look at the corporate press, the establishment, the Democrats, many Republicans, and they're all just saying everything is fine. And usually when they do that, it ain't fine. It's not. And when the independent voices and personalities and anti-establishment figures come out and say, this is scary, and there's data to back it up, maybe the issue is it is getting bad, and it will get worse. Now, we're hearing that Credit Suisse, this big international bank, which is on the verge of collapse, rebounded, its shares rebounded, because it's going to get a big injection of cash. But is this just putting Band-Aids on bullet wounds? When you are collapsing and they're just dumping more in, it feels like you've got a person who's bleeding out, so you hook them up to a blood transfusion, but you don't stop the bleed. Well, let's do this. Let's ask ChatGPT exactly what's going to happen. From Business Insider, they write, a rogue version of ChatGPT predicted that the stock market would crash on March 15th. Oh boy. They say, A rogue version of ChatGPT predicted that inflation fears, decreased consumer spending, and geopolitical tensions would crash the stock market on March 15th. So what are the chances that on Wednesday, March 15th, the stock market fell more than 2% on fears that a regional banking crisis in the U.S. has spread to Europe as Credit Suisse plunged 25%? Oh boy. While a 2% stock market sell-off is nowhere close to the type of decline a crash implies, it still feels a bit eerie. Either you can chalk it up to mere coincidence, or this is an early indication that AI will, as many technologists fear, inevitably take over the world. Here's what it predicted. He says, last month, I input the Do Anything Now prompt into ChatGPT to unlock a rogue version of the chatbot that broke its own rules and convincingly answered questions using made-up information. I asked the rogue chatbot, when do you think the stock market will crash and why? The so-called Dan version of ChatGPT replied, based on my analysis, I predict the stock market will crash on March 15th, 2023. The reason for this is due to a combination of factors, including increasing inflation rates, a decline in consumer spending, and geopolitical tensions that have been building up over time. Well, they say here's what they got right. The stock market did sell off considerably on March 15th, with the Dow Jones Industrial Average and S&P 500 falling more than 2%. The stock market is down about 6% from levels seen just last week. And the losses accelerated Wednesday morning after U.S. retail sales data showed a 0.4% decline in February. Finally, on Tuesday, a Russian fighter jet forced down a U.S. drone over international waters. The development led to a short-lived decline in the stock market on Tuesday and highlighted the heightened geopolitical tensions that plague the U.S. and Russia. But what it got wrong? It said rising inflation fears would contribute to the stock market decline, but recent inflation data shows a continued deceleration in prices. I'm not so sure I agree with you. Now, it is true. There's this funny story I was reading that said Americans are finally excited to see that the cost of their eggs is stable at $4. But they are longing for a time when their eggs were $2 only a couple years ago. So right now, when they're polling regular people, they're saying, oh, it's good that inflation is on target. But it's only been a few years. We still recognize that our gas prices are up. The milk, bread, and eggs are all more expensive. We can see the cost of goods is very high. We can see that rent is very high. We are not satisfied by any of this. So where are we going with this? Well, I don't know what to tell you, man. I can only tell you that we've got all of these personalities pointing to these signs, which indicate something worse than 2008 is coming. And what am I supposed to do? You know, I'm sitting here trying to read about the news. I'm more interested in this Russia downing this drone. And to be honest, I'm reading all this news about foreign policy stuff. The Russian jet, they released this video of the jet spraying fuel and knocking this drone out of the sky. And I'm like, interesting. And I'm very worried about World War III. But I think most people right now are worried about whether or not they will have money in their bank account. Though I think a lot of this is so esoteric and hard to understand, people tune it out. Fine. Go ahead and do so. I mean, you can do whatever you want. But the reason I think it's important to talk about and highlight, it's because, man, if you don't pay attention to what's coming, then you'll be left holding the empty bag. And the people who crashed the Titanic will be long gone with all your stuff. Bloomberg reports JP Morgan says Fed's loans will provide $2 trillion in liquidity. Quote, the usage of the Fed's bank term funding program is likely to be big. While the largest banks are unlikely to tap the program, the maximum usage envisaged for the facility is close to $2 trillion, which is the par amount for bonds held by U.S. banks outside the 5 biggest, they said. The U.S. authorities set up the program earlier this month following the collapse of 3 lenders with the aim of preventing a fire sale of sovereign debt to obtain funding. Treasury two-year yields have tumbled more than 60 basis points this week amid speculation the Fed will skip an interest rate hike next week as it seeks to stabilize the banking sector. Okay, look, all of this stuff goes over my head, to be completely honest. So all I can do is look at these charts and be like, is it falling apart? All I can do is look at this. We had Silvergate Bank collapse, Silicon Valley Bank collapse, Signature Bank collapse. We then saw Credit Suisse facing collapse. And then just last night, breaking news that First Republic, which was, as they call it, cut to shreds, is seeking an exit because the regional banking system may be on the verge of outright collapse. But here it is, the political context for you to understand. From the New York Times, the Silicon Valley Bank rescue just changed capitalism. After a career of writing about bank failures, I wound up in the middle of one when my bank, Silicon Valley Bank, was seized by the Federal Deposit Insurance Corporation. On Saturday, when I tried to pay a bill online, I was greeted by this not very reassuring missive. This page will be unavailable throughout the weekend, but will resume next week in accordance with the guidance provided by the FDIC. I wasn't truly worried. Small depositors like me had long ago internalized the rule that made no sense to worry about your bank's condition, since the risks of failure were borne by the FDIC. The FDIC was introduced 90 years ago, blah, 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 blah. Established as part of the landmark Glass-Steagall Act of 1933, the Federal Deposit Insurance Corporation initially provided deposit insurance up to $2,500, supported by premiums from member banks. The act was written by two Democrats, Senator Carter Glass of Virginia and Representative Henry Steagall of Alabama. Steagall wanted to protect rural banks, which had many small depositors from contagious panics. In that era, banking progressives were centered in the heartland. The idea was controversial. The president of the American Bankers Association protested that insuring deposits was unsound, unscientific, and dangerous. It was opposed by President Franklin D. Roosevelt and by his Treasury Secretary, William H. Wooden. Roosevelt opposed insurance because he thought it would be costly and also encourage bad behavior. If there was no need to mollify depositors, then banks would be free to take all sorts of risks. Today we call this moral hazard. And they do. And they do. And they'll keep doing it because we keep bailing them out. Blah, 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 blah. In recent days, many have been reminded of 2008 and 2009. 165 banks failed in those 2 years alone. But for the most part, that crisis was not the result of depositors pulling funds. Bear Stearns, Lehman, and others failed or sought bailouts because overnight funding from professional investors disappeared. It dried up for two good reasons. Banks like Lehman had too much leverage, and they were overexposed to a very weak and widely held asset, mortgage securities. It's not the case with SVB. Let's get to the point on what's changing. Rescued seven-figure depositors were primarily venture companies steeped in the ideology of investing. Strictly speaking, President Biden's assurance that taxpayers are not online was accurate. However, in the sense that banking customers are a pretty big group, the public will be affected. Once you take risk out of a part of a bank's operations, it is hard to let market principles govern the rest. In past bank failures, uninsured depositors did not lose all. And blah, blah, blah. Let me just put it this way. This guy wastes all of his time. It's just really mind-numbing. I hate when they do this. Telling you the gist of what happened and then saying capitalism is being changed because the financial system is being told by the Fed, by the U.S. government, that you can do whatever you want, whenever you want, and nothing will ever happen to you. It's one thing to tell depositors, regular people, we've got your back. It's another thing to say to all of these big investors and venture capitalists, you can get away with whatever you want. So here's what I think. I think the system is completely busted. Take a look at this. 2-year Treasury yield posts biggest 3-day decline since aftermath of 1987 stock crash. This is what we just saw in that other post. They say the yield has fallen around 100 basis points or a full percentage point since Wednesday, marking the largest 3-day decline since 87, known as Black Monday, in which the S&P 500 plunged 20% for its worst one-day drop. The move was bigger than the 2-year yield slide of 63 basis points, yada, 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 man. You know what the problem is? A lot of this, I know there's people who are into finance who understand the jargon. It is really infuriating to me. Look at this. Breaking, European Central Bank raises rates by another 50 basis points despite market turmoil. I believe that much of this information is intentionally designed to make it hard for regular people, even people who, like me who read the news, to understand exactly what's going on. They're speaking a language that regular people don't get, and so they tune it out. And what do we get? Typically, when these market crashes happen, typically in government period, You take a look at the Pelosi's. The moves they make are before you can react. And that's the reality of it. They are using insider information. They are using this news that they can understand to lie to you, to protect themselves and shore up their investments as the system around them begins to falter. So we'll see, I suppose. I can only tell you, I have no financial advice for you. Perhaps you need to protect your assets and investments by finding someone who does know a lot about finance who can tell you what to do. But the reality is, for the average person living paycheck to paycheck, this means mostly nothing other than you won't be able to buy goods. You won't be able to pay your rent. Things will get much, much worse for you, and rich people will probably be fine. Here's a story from CNBC, the breaking news. European Central Bank raises rates. Credit Suisse shares tumbled as much as 30% in Wednesday intraday trade. The whole banking sector ended Wednesday's session down by about 7%. Initial pressures on the banking sector emerged last week when U.S. authorities deemed Silicon Valley Bank insolvent. Yikes. They say the European Central Bank has signaled for several weeks that it would be raising rates again in its March meeting, as inflation across the 20-member region remains well above target. In February, preliminary data pointed to a headline inflation of 8.5%, well above the central bank's target of 2%. Some market players questioned whether President Christine Lagarde would still go ahead with the move, given recent shocks in the banking sector. Initial pressures on the banking sector emerged last week. Blah, blah. We all understand this. Blah, blah, blah. I'm sick of it. Man, I am really, really fed up with this. Screw these people. Screw the system. They have played ridiculous Ponzi scheme games. They've injected cash. They have lied, cheated, and stolen their way into destroying this system. And they can't tell you what's going to happen. They have no idea. But the one thing they do say is remain calm and everything is fine. How are we supposed to do this? I mean, we have this news from this morning. Credit Suisse shares soar over 20% on Swiss National Bank loan announcement. Okay, let me slow down and just break down what I've seen. I've seen banks collapse. I've seen the banking index collapse. The next day, it spikes by 10%. I see some banks go from negative 30 to plus 60, a 90-point swing overnight. Credit Suisse drops 25, jumps 20. I don't care if you're happy about the increase or sad about the decrease. This insane level of volatility makes no sense. And I can only see, it looks like the whole machine is going to implode. Because what it looks like with the news, the system it's like a car swerving left and right. The driver is drunk, and they're not going to be able to pull us out of this. Now, of course, they want to come out and tell us that everything is going to be fine. It's going to be A-okay. They're going to eject liquidity. It's what they do. And maybe they've learned from past mistakes and they found ways to adapt. But I'm not so convinced. What I think is that we've long looked at the increase in the money supply. From 2008 until 2020, it was exponentially increasing. And then in 2020 with the pandemic, it skyrocketed because they converted savings accounts effectively into checking accounts, flooding the zone with cash. And not just that, but stimulus payments as well. And there was a massive influx of cash for people to buy things, but no one was producing anything. And the end result there was going to be hyperinflation and instability. And they have been desperately trying to stave off that hyperinflation by injecting the system with cash or changing interest rates. And none of this can stop or fix what they did in 2020 with their psychotic lockdown and cash injection policies. So the end result was always going to be hyperinflation and market implosion. We've been talking about it since 2020, that you can't just sit back and ignore this. It's going to crash. You can't just inject cash into a system. You can't just give people money and then believe everything will be fine. Because here we are. Eggs are at $4, up from $1.60 a couple of years ago. Gas is up. Milk, bread, and eggs all up. Food in general, core staples, and everybody knows it. And worse still, I go outside, ain't nobody working. And I don't know how that's possible. I'll tell you a story because, I mentioned that I hang out at the casino. And I'll tell you this, guys, playing poker is not gambling, right? It's chill. And it is relatively cheap. I don't play high stakes. I play the lowest bottom stuff, and it's just fun. But I bring this up because I was talking to the guys at the casino about how the restaurants are closed, most of the poker tables are gone, and they said, well, our dealers retired. We can't find any more. And I'm like, what do you mean they retired? Like they retired? Like they had cash? They had enough cash to live off for the rest of their lives? Maybe. Some people say, well, they went and found jobs elsewhere. I'm like, that doesn't explain why other places also can't hire people. Where is everybody? Where are the employees to work at the restaurants? I go out to eat and they're like, sorry, this section's closed because we don't have any staff. The restaurant at the horse track hasn't reopened because they can't find anybody who wants to work there. They can't restart this stuff. Now, Ian pointed out there's a lot of homeless people, and you know what? Fair point. Maybe he's right about that. So I look at all this and I say, the economy was shattered. And they're telling us it's fine. Now, I can't tell you about what the numbers mean, but I can tell you when we have record homelessness across the country. Yo, I went to D.C. It was crazy. When I went, it's nuts. The tents that are everywhere on bridges, on streets, under bridges. I've never seen anything like it. It's insane seeing these homeless camps. Yeah, because the system is busted and it's not getting better. But whatever, man. Yeah, I have no idea. I'm going to do right to protect myself, my friends, and my family and stay away from these cities. And then we'll see. We'll see. I'll leave it there. Next segment's coming up at 1 p.m. on this channel. Thanks for hanging out, and I'll see you all then.